Imagine a life without alarm clocks, a life where work is a choice, not a necessity. Picture yourself waking up each morning with the freedom to do exactly what you want, when you want. This is the promise of early retirement, and it's closer than you might think. For many, the traditional path of working until their 60s or 70s feels less appealing than ever. The desire for freedom and control over our time is growing stronger. The good news is, early retirement isn't just a pipe dream reserved for the wealthy. It's an achievable goal for anyone willing to embrace a new approach to money and life. This isn't about winning the lottery or inheriting a fortune. This is about taking control of your finances, making smart investments, and designing a life you love, long before traditional retirement age. If you're ready to trade the daily grind for the freedom to pursue your passions, travel the world, or simply enjoy the luxury of time, then keep reading. This is your roadmap to early retirement. The first step towards early retirement is a mental one. It's about challenging the pre-programmed beliefs we've inherited about work and retirement. We're conditioned to believe that we must endure decades of grinding away at a job before we can finally relax and enjoy life. This traditional model often leaves us feeling trapped, trading our most valuable asset, time, for a paycheck. But what if there was another way? What if you could rewrite the rules and design a life where work was optional, not mandatory? Early retirement is about reclaiming that time, about shifting your perspective from "I have to work" to "I choose to work." It's about understanding that financial independence isn't a privilege reserved for the wealthy, but an achievable goal for anyone willing to embrace a new mindset. This shift begins by questioning the status quo. It's about recognizing that you have the power to define your own terms of success and happiness. Are you content with the traditional path, or are you ready to forge your own way to freedom? Before diving into investment strategies and budgeting techniques, it's crucial to establish a clear vision for your early retirement. What are your motivations for seeking financial independence? What dreams and aspirations will you pursue when you have the gift of time? Is it the freedom to travel the world, exploring new cultures and landscapes? Perhaps it's the ability to spend quality time with loved ones, creating lasting memories. Or maybe it's the chance to pursue a passion project, launch a business, or give back to your community. Having a strong why is essential because it will fuel your commitment and motivation when you encounter challenges along the way. It's easy to get sidetracked by societal pressures or the allure of instant gratification. But when your vision is clear and your desire for freedom is strong, you'll find the discipline to stay the course. So take some time to reflect on what truly matters to you. Define your why. Write it down and revisit it often. Your future self will thank you. Before you can even think about retiring early, you need to build a solid financial foundation. This starts with consistently saving a significant portion of your income. I'm not talking about saving 10% or even 20%. To achieve early retirement, you need to think bigger. I committed to saving at least 50% of my income, and while that might sound daunting, it's more attainable than you might think. It requires a shift in perspective and a willingness to prioritize long-term goals over short-term gratification. Start by tracking your expenses meticulously. You'll likely be surprised by how much you spend on things you don't need or even truly enjoy. Cutting back on unnecessary expenses like dining out, expensive coffees, and impulse purchases can free up a significant amount of money each month. Remember, every dollar you save is a dollar invested in your future freedom. It's about making conscious choices today to create the life you want tomorrow. Once you have a consistent savings plan in place, it's time to put your money to work for you in the market. My core investment strategy revolves around low-cost index funds. These funds are like baskets of stocks that track the performance of a specific market index, such as the S&P 500. Investing in index funds offers several advantages. First, they provide instant diversification. Instead of picking individual stocks and trying to time the market, you're spreading your risk across hundreds or even thousands of companies. Second, index funds typically have very low fees compared to actively managed mutual funds. Over time, these low fees can make a significant difference in your overall returns. Finally, index fund investing is a passive strategy, meaning you don't need to constantly monitor the market or make frequent trades. This allows you to focus on other important aspects of your life while your money grows steadily in the background. While the stock market plays a crucial role in my investment plan, I also believe in diversifying into other asset classes, such as real estate. Real estate offers a unique combination of benefits, including passive income and long-term appreciation. Rental properties, in particular, can be a powerful tool for building wealth and generating consistent cash flow. By owning rental properties, you're essentially leveraging other people's money, rent payments, to build equity in an appreciating asset. The key to successful real estate investing is to focus on properties that generate positive cash flow, meaning the rental income exceeds the expenses associated with owning and managing the property. While real estate investing requires more hands-on involvement than index fund investing, the potential rewards in terms of passive income and wealth creation make it a worthwhile addition to any diversified investment portfolio. One of the most powerful forces in investing is compound growth, often referred to as the snowball effect. Compound growth is the concept of earning returns on your initial investment, as well as on any accumulated interest or earnings. To illustrate, imagine investing $10,000 in an index fund that earns an average annual return of 8%. After the first year, your investment would grow to $10,800. In the second year, you'd earn 8%, not just on your initial $10,000, but also on the $800 in interest earned the previous year. Over time, this compounding effect can create substantial wealth. The earlier you start investing, the more time your money has to compound and grow exponentially. Even small amounts invested consistently over long periods can lead to significant results. While it's essential to be aggressive with your savings and investments, it's equally important to manage risk effectively. Diversification is key. By spreading your investments across different asset classes, such as stocks, bonds, real estate, and even alternative investments, you reduce the impact of any single investment performing poorly. Mastering your money. The power of budgeting. Let's talk about a fundamental principle of early retirement living below your means. Now, this doesn't mean embracing a life of deprivation. It's simply about being mindful of your spending habits and making intentional choices with your money. And it all starts with a budget. Think of a budget as a roadmap for your finances. It helps you track where your money is going, identify areas where you can cut back, and ensure you're prioritizing your savings goals. Luckily, creating a budget doesn't require complicated spreadsheets or financial expertise. There are fantastic budgeting apps available like YNAB, You Need a Budget, or Mint that simplify the process and provide a clear visual representation of your income and expenses. Even a simple spreadsheet or a notebook can do the trick. The key is to be consistent. Set aside some time each week or month to review your spending, categorize your expenses, and make adjustments as needed. Remember, knowledge is power. By understanding your spending patterns, you can make informed decisions that align with your early retirement goals. Outsmarting impulse, buys and finding fulfillment. One of the biggest obstacles to saving money is often our own impulsive spending habits. We live in a world of instant gratification, bombarded with tempting ads and enticing sales that urge us to spend, spend, spend. But breaking free from this cycle is crucial for early retirement. One effective strategy I've adopted is the 30-day rule. If I find myself wanting to make a significant purchase, I simply wait 30 days before actually buying it. Often, that initial desire fades away, and I realize I didn't need the item after all. But living below your means isn't just about saying no to every purchase. It's about finding fulfillment in experiences and things that truly matter to you. It's about prioritizing quality time with loved ones, pursuing your passions, and creating memories that will last a lifetime. Remember, true wealth isn't measured by the size of your bank account, but by the richness of your experiences and the strength of your relationships. By shifting your focus from material possessions to meaningful pursuits, you'll find that living below your means becomes less about deprivation and more about intentional living. Unlocking savings in housing and subscriptions. Let's face it, housing is typically the largest expense for most people, but it's also an area where you can potentially unlock significant savings. Think about it. Do you really need that sprawling house with all the bells and whistles? Or could you be perfectly content in a smaller, more affordable space? Downsizing to a smaller home or exploring alternative living arrangements, like house hacking, renting out a portion of your home, can free up a substantial amount of money each month. And that extra cash flow can be directed towards your investments, accelerating your path to early retirement. Another area ripe for savings is monthly subscriptions. We live in a subscription-based world, with recurring payments for streaming services, music apps, meal kits, and more. While these services can offer convenience and entertainment, they can also quietly drain your bank account. Take some time to review all your subscriptions and be honest with yourself. Are you really using that gym membership? Do you need all those streaming services? Chances are, you can identify several subscriptions you can comfortably live without, freeing up even more money to invest in your future. While a traditional 9-to-5 job can provide a steady paycheck, relying solely on one income stream can feel precarious, especially when you're aiming for early retirement. Imagine this. What if you could create a network of income sources, each contributing to your financial well-being? That's the power of multiple income streams. Think of it like building a sturdy table. A table with one leg is inherently unstable, but a table with multiple legs can withstand much greater pressure. Similarly, having multiple income streams provides financial stability and resilience. If one income source falters, you have others to fall back on. Early in my journey, I realized that my 9-to-5 job, while stable, wouldn't be enough to achieve my early retirement goals within my desired time frame. So I started exploring ways to generate extra income on the side. I tapped into my skills and interests, taking on freelance projects in the evenings and on weekends. The beauty of side hustles is that they allow you to leverage your existing skills, explore new passions, and potentially turn those passions into profitable ventures. Whether it's freelance writing, graphic design, web development, or teaching online courses, there are countless opportunities to supplement your income and accelerate your journey to financial independence. Now, let's talk about passive income, money that flows in with minimal effort on your part, even while you sleep. Two of my favorite passive income powerhouses are dividend-paying stocks and real estate. Dividend stocks are like silent partners in your financial journey, consistently rewarding you for your investment. When you invest in companies with a history of paying dividends, you're essentially receiving a share of their profits on a regular basis, typically quarterly. These dividend payments can be reinvested back into your portfolio, further accelerating your wealth-building journey. Real estate, as we discussed earlier, offers the dual benefits of passive income through rental payments and long-term appreciation. By owning rental properties, you're essentially building a portfolio of assets that generate cash flow month after month. The key is to acquire properties with positive cash flow, ensuring that the rental income comfortably covers the mortgage payments, property taxes, insurance, and any other associated expenses. Over time, as you pay down your mortgages and property values appreciate, you'll be building substantial wealth and creating a steady stream of passive income. The digital age has ushered in an unprecedented era of income-generating opportunities. We live in a world where you can create and sell digital products, share your knowledge through online courses, and build an online audience around your passions, all from the comfort of your own home. One of my favorite ways to generate passive income online is by creating digital assets, such as ebooks, online courses, and templates. These assets, once created, can be sold repeatedly without requiring significant additional effort. Imagine writing an ebook on a topic you're passionate about, creating an online course sharing your expertise, or designing beautiful templates that others can use. These digital products can become sources of passive income, generating revenue even while you're not actively working on them. The beauty of the digital age is that it has lowered the barriers to entry for entrepreneurship. You don't need a fancy office or a large team to launch a successful online business. With a laptop, an internet connection, and a dash of creativity, you can turn your skills and passions into profitable online ventures. Weathering the storms, staying calm amidst market fluctuations. The financial market, much like the open sea, can be unpredictable. There will be calm days and stormy days. We've all seen the headlines: market crashes, recessions. Panic is not an investment strategy. History shows those who stay the course are rewarded. Short-term fluctuations are like ripples on a vast ocean. Embracing volatility, dollar cost averaging, and the power of patience. Now, while weathering the storms is essential, there's a powerful strategy that can actually turn market volatility to your advantage. Dollar cost averaging. This simple yet effective technique involves investing a fixed amount of money at regular intervals, regardless of market conditions. Think of it like this: when the market is down, your fixed investment buys you more shares at a discount. When the market is up, you buy fewer shares, but those shares are worth more. Over time, this approach helps to smooth out the ups and downs of the market, potentially reducing your average cost per share. Dollar cost averaging takes the emotion out of investing. You're no longer trying to time the market, to predict when to buy low and sell high. Instead, you're consistently investing, rain or shine, taking advantage of market dips to accumulate more assets. This strategy requires patience and discipline. You might not see immediate, explosive gains, but remember, slow and steady wins the race. By consistently investing and letting the power of compound growth work its magic, you'll be amazed at how your wealth can grow over time. Safety nets and strategic shifts. Protecting your nest egg. While embracing market volatility and investing for the long term are crucial, it's equally important to have safeguards in place to protect your investments and ensure you're prepared for unexpected events. One of the most important safety nets you can have is an emergency fund. An emergency fund is a separate savings account containing 6 to 12 months' worth of living expenses. This fund serves as a financial buffer, providing peace of mind and protecting you from having to sell your investments at a loss during a market downturn or unexpected financial hardship. In addition to an emergency fund, it's wise to consider adjusting your investment strategy as you approach your early retirement target date. While you might have been comfortable with a more aggressive, growth-oriented portfolio in your younger years, as you get closer to retirement, it's prudent to gradually shift towards a more conservative approach. This might involve allocating a portion of your portfolio to less risky assets, such as bonds or fixed income investments. While these investments might not offer the same growth potential as stocks, they can provide stability and income, acting as ballast for your portfolio during times of market turbulence. The 4% Rule, a time-tested guideline. Congratulations! You've diligently saved, invested wisely, and built a substantial nest egg. Now comes the exciting, yet often daunting part. Figuring out how to withdraw from your retirement savings sustainably. You've worked hard to achieve financial independence, and you want to ensure your money lasts throughout your retirement years. One widely accepted guideline for retirement withdrawals is the 4% rule. This rule of thumb, based on historical market data, suggests that you can safely withdraw 4% of your retirement portfolio each year without running out of money for at least 30 years. For example, let's say you have a retirement portfolio of $1 million. According to the 4% rule, you could withdraw $40,000 in your first year of retirement. In subsequent years, you would adjust that initial withdrawal amount for inflation to maintain your purchasing power. While the 4% rule provides a helpful starting point, it's important to remember that it's just a guideline, not a hard and fast rule. Your individual circumstances, risk tolerance, and market conditions might warrant adjustments to this withdrawal rate. Navigating market shifts. Adjusting your withdrawals. The financial market is a dynamic beast, constantly ebbing and flowing. There will be years of robust growth and years of inevitable downturns. While it's essential to stay the course with your long-term investment strategy, you'll likely need to make adjustments to your withdrawal rate during periods of market volatility. During a prolonged market downturn, withdrawing 4% from your portfolio could deplete your savings faster than anticipated. In such scenarios, it might be prudent to temporarily reduce your withdrawal rate to allow your portfolio time to recover. Conversely, during periods of strong market growth, you might consider slightly increasing your withdrawal rate, allowing you to enjoy the fruits of your investment success. The key is to be flexible and adaptable, adjusting your withdrawals as needed to maintain a sustainable balance between enjoying your retirement and preserving your capital. It's also important to consider diversifying your income sources during retirement. While your investment portfolio will likely be your primary source of income, having additional income streams, such as a part-time job, a rental property, or passive income from a business or online venture, can provide flexibility and peace of mind. Tax efficiency and flexibility. Optimizing your strategy. When it comes to retirement withdrawals, tax efficiency should be top of mind. Remember, it's not just about how much money you withdraw, but how much you get to keep after taxes. Creating a tax-efficient withdrawal strategy involves carefully considering the tax implications of withdrawing from different types of retirement accounts. For example, withdrawals from traditional IRAs and 401ks are taxed as ordinary income, while withdrawals from Roth IRAs are generally tax-free in retirement. Understanding these tax nuances can help you minimize your tax burden and maximize your retirement income. Finally, flexibility is key to a successful retirement withdrawal plan. Life is unpredictable, and your needs and circumstances might change over time. Building flexibility into your plan allows you to adapt to unexpected expenses, market fluctuations, or changes in your lifestyle or health. Consider working with a qualified financial advisor who can help you create a personalized retirement withdrawal strategy tailored to your specific goals, risk tolerance, and financial situation. A knowledgeable advisor can provide valuable guidance, helping you navigate the complexities of retirement planning and optimize your financial well-being throughout your golden years. Your journey to freedom starts now. Early retirement might seem like a distant dream, something reserved for the wealthy or the lucky, but the truth is, it's an achievable goal for anyone willing to embrace a new mindset, adopt sound financial habits, and commit to a long-term plan. It's not about depriving yourself or living a life of austerity. It's about making conscious choices today to design the life you want tomorrow. It's about trading the daily grind for the freedom to pursue your passions, explore the world, spend quality time with loved ones, or simply savor the luxury of time. Remember that early retirement is a journey, not a destination. There will be challenges along the way, market ups and downs, and moments when you might question your choices. But during those times, remember your why. Visualize the life you're creating, the freedom you're working towards, and the sense of accomplishment that awaits you. Surround yourself with a supportive community, whether it's family, friends, or like-minded individuals who share your goals. Your journey to financial independence starts now. Take that first step, no matter how small it may seem. Start saving, start investing, and start living a life of intention and purpose. The future is yours to create.